Hello, and welcome to Protivity's webinar entitled Global Finance Trends Survey.
Welcome to today's webinar. As a global consulting firm, Protivity is here to help you connect, grow, succeed. We invite you to visit us online at protivity.com/webinars to find other great content and subscribe. Now, let's begin.
Hello, everyone, and welcome to Protivity's webinar entitled Global Finance Trends Survey Part 1, A Tale of Transformation for CFOs. We are glad you're here and hope you will find today's material meaningful and insightful. Before we begin, I'd like to go through a few housekeeping items. Audio will be streamed through your computer. Google Chrome or Microsoft Edge are the recommended browsers. If you are having any trouble with the webinar viewing, please log off and log back on using one of those browsers. Today's webinar is being recorded and will be available on demand. Please check out the Resource Center on your screen for other great materials that we think you'll find valuable. If you experience difficulties during the webcast, please let us know via the Q&A box. You can also go to the help icon for recommended tips for technical difficulties. Please also use the Q&A box for any questions that you have during the webinar. The presenters will answer as many as possible at the end of the webinar. CPE is available for the live version of this webinar only. By attending the full live session and responding to the random polling questions, you will receive 1 CPE credit. Now, I'd like to introduce today's speakers. Our first presenter will be Chris Wright. Chris is a managing director in Protivity's New York office and firm-wide leader of our business performance improvement solution. He oversees our finance, transformation, and transaction services, supply chain, operations, and people and change practices. Next, we have Andrea Vardaro-Thomas. Andrea is a managing director also in our New York office, leading Protivity's business planning and analysis practice. And last but not least is Andrea Spinelli. Andrea is a managing director in our Boston office with experience in accounting and finance operations, target operating model design, shared services, and process optimization. And with that, I will go ahead and hand it over to Chris to get us started.
Thanks, Liz, and welcome everybody to this webinar. We always find a great deal of interest, and we're pleased that hundreds of you are joining us today to hear what other CFOs had to say. I'm Chris Wright, as Liz mentioned, and I'll first start us off by walking through our agenda. We'll plan on identifying the top priorities for CFOs that were identified by CFOs and people with adjacent titles over the next 12 months. Branching off from those prioritizations of which they advised us, we'll talk about how finance organizations are utilizing generative AI, how they're making progress optimizing costs, often using generative AI, and then describe some of the key actions that CFOs and finance leaders are looking to do, or on which they hope to focus going into 2025. A little bit, it's important to understand who participated and how. As I mentioned, this is not Protivity telling you what to think or how to think or what others are thinking about. This is about 1,000 respondents, 961. It was a little over 900 last year, a little over 1,000 the year before, from a number of finance titles, CFO and adjacent titles, consistent with the fact that about 2/3 of our respondents were large public companies. And so you're likely to see divisional titles and the like that are consistent with being part of the finance organization. A very good cross-section of industries, almost identical percentages between manufacturing and distribution and financial services, with strong participation by tech and media, consumer products, healthcare, energy, utilities, and a government presence that we noticed last year and which continues this year. And some of these demographics may affect how some of the responses vary from year to year, so it's important to note them. And from a size perspective, just about 60% of the companies are over $1 billion in size. You can see that the government agency sizes tend to be substantial as well. Actually, 10 billion or more being over half of the universe there for the 9% that were government respondents, and then assets under management also substantial, 25 billion or more, 10 billion or more being most of them, 25 billion or more being just about half of them. So a good cross section from industries, and then within the industries, a good cross section of sizes of either agency, financial size, assets under management for financial services, and revenue for the operating companies. Demographically, as I mentioned, just about 2/3, 68%, were publicly held. A number of privately held, and then the government was about 9%, making up to 100%. So 68, 23, and 9. From a size perspective, a number of them identified themselves as global, and that was our definition for you operate in more than one country. National, you operate largely, but really in a substantial way within the country of origin. Regional speaks for itself, and of course local would be more of a narrow focus from a size of either the company or the agency. And then 45% from the United States, which obviously just over half not from the United States, and a good cross-section across the European Union and Asia Pacific. So really some good perspectives that help inform our Q&A. So to set the stage, we'd like to start with a polling question for you all, similar to what we asked the CFOs in our survey, and those with adjacent titles. So what is your top priority for finance organizations over the next 12 months? Is it financial planning and profitability analysis and reporting? Is it security and privacy of data? Is it strategic planning, process improvement, or routine reporting and closing activities? Please take a moment to answer the questions, and as the results come in, we'll move to the results and see how you all replied relative to how some of the others replied. Okay, we're coming on about 70%. We'll give it another moment, and then we'll see what the group thought. This is the moment of truth where we compare to what this is a pretty substantial audience compared to about 1,000 respondents, but it's significant. And so we're at about 90% of responses. So let's see what you all thought in terms of priorities. So just over a quarter, financial planning, profitability analysis, and reporting. Just over 1/5, security and privacy of data. Strategic planning, again, about 1/5. Process improvement, just over a quarter as well. And a minor participating role for routine reporting and closing activities. So let's see what our 950 plus respondents, and I should point out that survey was in the field in May or June of this year, give or take, and so that time stamps it a little bit, but we can compare that to today's results. The top finance priorities for our respondents, and we've given you the top 15 because we'd like to account for last year's top 10. Security and privacy of data was number 1. It's been on our top 10 list for quite some time. It was number 5 last year. FP&A and profitability analysis and reporting was not a separately asked question. It was 2 separate questions last year, but it came in as number 2. Strategic planning, number 3. Routine reporting activities, number 4. And you'll notice not a lot of bandwidth between or space between the responses. They were pretty tightly clumped at either very important or really important. Process improvement, the leadership within the organization, within the finance organization itself, data analytics and cloud-based applications. ESG, which was number 1 last year, still on the list, but number 9 this year, but still strong. The demands and expectations of internal customers was basically made the top 15 last year, and it's number 10. And then a number of items from last year's top 10, tax changes, the role of human resources and leadership and development, which you could argue is similar to the leadership question, which was number 6 this year, transaction planning and readiness, and then mobile finance applications and AI. We mentioned AI as a specific topic, but we'll dive into that because it really cuts across a number of our responses, and we've grouped them together, and we'll share that in a minute. But really emerging from the key findings, clearly, security and privacy of data was the top priority. It's number 1. FP&A capabilities being table stakes, a must-do and part of the increasing and statements that affect CFO organizations. It's one more thing to do, never anything coming off the list. Generative AI moving forward as a tool being used by the finance organization, not only for its own reporting, but to help the company achieve cost savings, cost optimization itself, and then CFOs taking charge of sustainability, disclosures, and reporting because it's numbers. You're the stewards of numbers, and it's reporting, and CFOs are expected, particularly at public companies, and recall 2/3 of our respondents were public companies. that is an area where the CFOs tend to take charge because there's muscle memory about producing complete, accurate, timely, and verifiable information for the public's consumption. For today's webinar, we're going to be talking primarily about security and privacy of data, the number one priority, and the security and privacy and sustainability are going to be for the upcoming webinar, the future webinar. For today, we're going to talk about FP&A, generative AI, and enabling cost optimization. So we're going to do that with some speakers who are really steeped in the details and working with clients every day on how we solve the problems around FP&A using AI in finance and using both and other means to manage costs in the organization. Well, I mentioned earlier, although AI, for example, was the number 15 priority, we took a look at the answers. We don't ask a lot of follow-up questions. It's a rather long survey, but we interpret the data to the extent that we can and group them in areas where there's some consistency. And you'll note that AI, for example, is an area everyone's talking about it. Everyone's doing something with it. They're probably doing more than they realize with it. And it affects security and privacy of data and FP&A and strategic planning. It's being used for all of those areas. It's being used for process improvement and automation. It's being used as a tool to keep people in your organization interested in staying in finance, maybe as data scientists as well as accountants, and for data analytics, and to really deal with the demands of internal customers for more and more interesting information. So AI was a river that ran through most of the top 10, 8 of the top 10, 7 of the top 10, similarly with FP&A, and we'll talk about that, and then cost optimization for 5 of the top 10. I thought we would group those together to give you a sense of why on this webinar, unlike the others, we're going to talk about these topics in particular in the context of the top 10. And so with that, I'm going to turn it over to Andrew Verdara-Thomas, who's going to start us off on the notions of how AI is being used in finance.
Thanks, Chris. We're actually going to dive into the FP&A topic and just look at the survey results as it relates to FP&A. So we saw that just under 70% of finance leaders that were in publicly held companies that responded to the survey rated FP&A and profitability analysis and reporting as that high priority for the coming year. And we saw that this was notably higher when you compare it to the finance leaders in private companies. And it's most likely because public companies have those shareholders that have those high expectations for routine analytics around the business performance on a quarterly basis for what's being disclosed. We're also seeing more and more of the expansion of traditional financial planning and analysis activities to really embrace business strategy and incorporate the business partnerships between finance and really nearly every function throughout the organization. And that's why we've expanded our definition of traditional FP&A to include a more robust meaning, termed it business planning and analysis or BP&A. So what exactly do we mean by BP&A? So from what I've seen from our clients, and I'm sure we all continue to experience, we continue to see that prolonged period of volatility, unpredictability, uncertainty, and even aggressive competitive landscapes. And the FP&A teams continue to be influential on how organizations respond to this. They play that important role to help guide the organizations with their, the financial planning, performance analysis and reporting, and proactive risk management. But FP&A can only do this meaningfully if they're cultivating strong strategic business partnerships across the organization. And that's really in addition to just the basics of, leveraging their technology and innovation, maintaining transparency of financial performance, and continuing to be inquisitive on the day-to-day. So what we have highlighted on this slide are really some of those best practices that help to expand the traditional FP&A function to incorporate the business aspect of business planning and analysis. So if you look at the top section of this, you'll see the traditional FP&A processes, and those generally focus on, FP&A developing their financial models, running relevant data and assumptions through the models to produce a budget or a forecast, preparing monthly management reporting, and that includes budget versus actual, variance analysis reporting, and then reforecasting based on financial performance to date and updating any model assumptions. But when we expand that scope to include the business partners in the process, that's where we look at that lower layer of this slide we incorporate the relevant feedback from the business and what should be a continuous and routine feedback loop. And the most successful BP&A processes that I've seen, the FP&A team plugs the business into every aspect of their planning process. So making sure that the assumptions that they're using are aligned with overall business strategies, and that they also reflect the impacts of any business tactics that are being used to achieve the strategies. So, as an example, this could be layering in the anticipated impact of promotional activities, or if there are some known competitive actions that the business is aware of, they might have a response to those actions. So how is that getting layered into the FP&A, modeling as well? This also includes, planned investment to drive future growth and perhaps anticipated new product launches. And then likewise, I've seen business partners leveraging ongoing support of their FP&A teams more and more. And that really is to help inform proactive and strategic business decisions that can be based more on data-driven analytics than that gut feel that we've seen and I've seen in my experience on the FP&A side, with the business. And it's these types of strong business partnerships that usually manifest themselves in a collaborative cross-functional process to identify and track risk and opportunities. And, as companies establish and identify what those risk and opportunities are, that's typically going to drive some analysis or scenario planning to determine those actions that the company might take to mitigate the risks or seize the opportunities that have been identified. So it's really, integrating the business into those traditional FP&A activities better positions finance organizations, allows them to be more agile and helps their organizations to navigate some of these market conditions and those uncertainties. So as I work with a lot of my clients, they look to transform their organization from that traditional FP&A to BP&A. And there are some common themes or areas of focus that generally come to light as a challenge for those finance leaders to be able to support their business partners, to help them capitalize on opportunities and allow for continued growth and profitability. And the first is aligning the company strategy and the financial plan. So I know that it's budget season for many companies, especially if you're on a calendar year. And I would venture to guess that some of you are probably starting your planning process with a focus on the strategic plan versus the financial plan. And that's great. And I would say that's more of the best practice. We would always recommend that you start your annual planning and budget target setting based on a long-range financial plan, so a 3 or 5 year model, and that plan should be aligned with the overarching strategic plan that's been agreed to across the organization. That company strategy should be the North Star, and the finance organization should also be involved in the strategic planning process, because there's a lot of value that the finance organization can provide just by, preparing insightful analytics around financial trends or running various scenarios as the strategy is being developed to help drive more of those informed strategic decisions. And if finance is plugged into that strategic planning process, it'll also help to strengthen finance's partnership with the business to allow for, more cross-functional inputs. You want that dialogue, the collaboration throughout the year, especially as you look to reforecast the business and help to inform the future business decisions. CFOs and finance leaders also play a critical role in monitoring and analyzing KPIs to assess the financial health and operational efficiency of the organization. But to do this successfully, though, it's important that you have comprehensive mechanisms in place for tracking and reporting the KPIs, which almost always serve as inputs or assumptions into the financial budgets and forecast models. Data quality, data management, data governance, they're all critical areas of importance, especially as you start to begin to deploy some of the advanced analytic tools and methodologies. And this is going to provide finance with a solid basis to help their business partners identify those areas of opportunity, develop the proactive action plans, again, to seize those opportunities and hopefully drive an increased profitability throughout, all various channels. I cannot stress enough, though, the power of using data-driven analytics in the finance processes. And usually the most impactful analyses that FP&A teams can prepare are focused on driving top line growth and profitability by optimizing revenue and even looking for those opportunities to optimize spend and costs. And this includes using those advanced analytics like AI and machine learning, and we'll get into some use cases shortly. Now, to facilitate these analytics and reporting capabilities, the adoption of new technologies and digital transformation might be necessary. And CFOs are really in a unique position to influence and drive digital transformation across their organizations. I mean, think about it. CFOs can lead those initiatives because they understand the initiatives. They can align that with strategic goals and also prepare the analysis to substantiate the investment dollars necessary. And I think we all know that these are some substantial investments, and CFOs can help to direct those strategic budget dollars that might be earmarked for the technology upgrades, new innovations that can be used to really enhance the operational efficiencies, but also to support more impactful analytics and drive those business decisions. Also, with new technologies and new ways of working comes upskilling of talent and bringing new talent with the advanced analytical skill sets that should also be considered as you transform the organization. But the other area that is also a critical focus and shouldn't be forgotten is having a robust change management plan to overcome any resistance to change. And I've seen that be a common hurdle through any transformation or technology modernization. So with that in mind, why don't we move to our next polling question? So how is your company currently incorporating AI into existing finance processes? Extensively, AI tools are deeply embedded in the finance function. Moderately, AI tools are used for specific tasks within finance. Minimally, we are exploring or experimenting with AI in finance, or not at all. AI is not part of our finance function. And while we're waiting for the responses, I'd like to point out that using AI is more than just ChatGPT. So broadly speaking, we hear the terms generative AI, machine learning, large language models, and all of these are forms of AI that can be used to drive process efficiency and automation, customer experience, and even that business decision support. And again, these are just a few areas. There's so many opportunities to leverage AI. So we're just waiting for some responses to come in. I think we're at about 85%. So why don't we look at the results here? So interesting, the almost half are minimally using, right, exploring or experimenting with AI in finance. And I'll say just based on what I'm hearing in the field and companies that I'm working with or speaking to, that's fairly consistent with what we hear. So if we compare that to, our survey results. So our survey results indicated that only 34% of the respondents are currently using some form of generative AI. Worth noting that 44% of these organizations that are using Gen AI were from public companies and 29% from private companies. It's probably at least the balance on the public and private companies is, public companies probably have a greater willingness to invest in the technologies. Gen AI can have, immediate benefits to drive efficiencies and processes related to the close, forecasting, all layers that are important as a public company. And, we know we can never have enough time before, doing your quarterly filings and earnings. So our survey results also reveal that CFOs are using Gen AI tools to generate returns in a few key areas, right? Process automation. We look at budgeting, forecasting, and cash flow management, and also cost optimization. So, it's clear that CFO and finance leaders are focused on advancing AI deployments that can support increasing revenue and improving profitability. And really, you can see all the areas on that the survey responses really support that, right? Process automation, risk management, expense management, scenario planning. So, while we hear of all the benefits of AI, and it sounds like through all of the responses on the poll and in the survey, the most common question is, how can I actually use AI in my finance organization? And, again, there's a whole host of examples. It can be exponential. So if we dive into some examples. And we'll look at this by business process within the finance organization, just to drill it down. And starting with order to cash process, one use case that can be considered for order to cash and even cash management is using AI to help you manage your accounts receivable more strategically. So if you think about building a machine learning model to project AR, you want to look at the correlations in data from both internal and external data points. And it's really data that's going to inform and drive the analytics. So if you think about the data points that would be important in this type of analysis, you'd start with customer data, right? Looking at the size, industry, payment history, credit ratings, and even customer segmentation if that's available. You'd want to look at existing contract data, payment terms, credit limits, any discounts that you might be offering to customers. Transactional data is also important, looking at the historical and projected sales to identify some of those trends and seasonalities, and perhaps even some of the payment patterns that can help predict future payment behaviors. And also historical DSO trends can be indicative of future trends as well. If we think about the external data, economic growth rates and interest rates could also have an impact on your customers' ability to pay, or just industry trends or market demands that would impact revenue projections and down the line your AR. Another interesting data point to explore is behavioral data, if that's available, right? So looking at your customer communication plan and the response patterns to that, or frequency and timeliness of customer engagement by the AR team. Some other use cases for the order to cash process. So, you can analyze customer data to identify patterns with the customer base across different demographics, preferences, purchasing trends to help better target marketing messages and inform pricing strategies. Or you can take sales data and analyze that to provide insights around opportunities to expand customer relationships. If we look at procure to pay, Gen AI techniques can be used to analyze spend, analyze vendor data, make recommendations for more optimal vendors or specific goods and services that can contribute to an overall reduction in expenses while maintaining or improving the quality of what you're receiving. Another use is to use AI to predict supplier lead times. So leverage AI to forecast how long it will take suppliers to fulfill orders, and then also use it to optimize order placement schedules or prevent stockouts or overstock situations. AI tools can also be used to monitor payment transactions for suspicious activities that can help to reduce the risk of fraud, improve some of your security tactics, and ensure compliance with internal controls. If we move on to record to report, I work with many companies that are looking to improve or accelerate their financial close processes so they can spend more time focused on analyzing results and partnering with the business. So there are certainly efficiency gains that can be gained from using AI to automate tasks during the monthly close process, like account reconciliations, accruals, consolidations, and eliminations. It's really automating the repetitive and time-consuming activities that can help finance teams to focus more on the higher value tasks, especially during month, quarter, and year-end processes. If you're a public company, you know that tagging financial data into XBRL formats can be another time-consuming effort, right? So AI can be used to tag the data in the required format and allow your finance team or the reporting team to focus more on the analytical aspects of your Qs and Ks. So MD&A as an example. And then lastly, if we look at business planning analysis, machine learning techniques in financial modeling, I would say is most prevalent in terms of how it's used in budgeting and forecasting. It's a key element here. So naturally, the data inputs into the models that you're using, so similar to models you might be using today, perhaps in Excel or other tools, they're very specific to your company and your company's industry. So you could use machine learning techniques to analyze historical trends over time, right? The company's future strategies and incorporate areas of investment that might impact those trends. Looking at industry, right? So business drivers that are relevant to your industry, how they might impact your business, and perhaps even data related to your competitive landscape. So looking at your promotional calendars and if your competitors' promotional activity is known as well. And then again, always those external data points. So you'll want to look at internal and external. So interest rates, macroeconomic factors, they all can have an impact on your organization. And likewise, they could impact those machine learning models. One interesting example of external data points I've seen from machine learning forecasting is actually weather patterns relative to the traffic and attendance at theme parks. And that ultimately translates to revenue projections, and it even can shape certain operational activities. So as you think about business partnering, sometimes you get creative with this information, but it's all about the correlations. Another example, predictive analytics and machine learning techniques can also be used to determine future demand for consumer products. And we see this a lot with demand planning and the related sales forecasts, again, based on historical trend, market trends, and underlying data. Machine learning can also be used to analyze variances between actual and forecasted financials. So instead of manually investigating differences, AI can automatically generate those explanations for the differences and identify some of the key drivers behind your variances. And this won't only save time, right? There's an efficiency gain here, but it might also be able to provide some deeper insights into why variances might be occurring. So again, just a few examples that you can consider. I know, these are questions that we get all the time, but I will say one item that I cannot stress enough is making sure that you've established a formal data strategy. There's various data points that you want to ingest into these models, both internally and externally. So I always go with the motto, garbage in, garbage out, right? So you want to make sure that you start with the data before you start diving into creating some of these more advanced analytics and robust models. And as we think about incorporating some of these best practices and the advanced analytics into your day-to-day FP&A practices, I think the focus really should be on how you can support your drive for profitability as an organization by providing those valuable insights to the business so that they can focus on optimizing revenue and optimizing their spending strategies in a meaningful and efficient way. So when I talk to most CFO and finance leaders and we talk about driving profitability, and even when I worked on the industry side and we had these conversations, the discussion typically goes directly to cost cutting. And while there's a benefit to cost reduction and optimizing the way you're spending, I did want to highlight that focusing on top line growth is just as important, especially, to be sure that your organization is not inadvertently reducing the size of the business and, trying to cost cut their way to profitability. FP&A, finance business partners, you're all well positioned to guide your business partners so that they can make the optimal decisions for their organization. And the use of data-driven analytics and those strong business partnerships can help to support these types of business decisions, especially related to revenue growth. And, we've listed on this side some of those, types of analytics that you should be thinking of. You can use AI and machine learning to achieve all of these, but, as we've seen, most are starting to experiment. So even if you're not using those advanced analytics tools yet, there are some basic analytics just around product mix, around pricing, that you can use to provide some valuable insights to business partners so they can make those more informed decisions. And again, not rely on their gut or what's worked in the past. So ultimately, it's the CFO and finance organization's role to help drive strategic decision making, and that can help shape the trajectory of your organization's long-term financial success. And with that, I'd like to move on to polling question number 3. Which approach best describes your company's strategy for cost optimization? Use of advanced analytics and spend management tools, focus primarily on cost cutting to achieve profitability targets, optimize spend by reallocating resources to high priority projects, optimizing spend by streamlining operations and increasing efficiencies, no formal strategy, or don't know, not applicable. And while we're waiting for your responses, I'd like to turn it over to my colleague, Andrea, and maybe she can talk a little bit about what she's been seeing from her clients.
Right. Thank you very much, Andrea. And as we're waiting for the rest of the responses to come in, I want to piggyback a little bit on something you started to talk about cost cutting. For purposes of our survey and what we're going to talk about today, we're going to talk about cost optimization. right? Which is very different from the exercise that I think most, if not all of us, have been through before, and that is cost cutting, right? With cost cutting, the goal is to reduce expenses very quickly, right, to improve the short-term financial performance. I think as we've all seen, it involves either eliminating or reducing certain activities, certain resources, certain services. It might include layoffs, budget cuts, reduced service levels. It depends on how extreme it needs to be. And while cost cutting does often result in immediate savings, it can sometimes lead to reduced quality or efficiency if it's not managed carefully. On the other hand, and what we're going to talk about in more detail today, cost optimization, it has the goal of maximizing value and efficiency throughout the business. It focuses on really thinking about strategically allocating resources and funding to get the best quality, efficiency, and cost outcomes. So cost optimization is really a continuous process that has several components. We're going to talk about them in a minute here. It's improving processes, enhancing productivity, investing in technology to ultimately reduce cost, but not compromise quality or performance. The goal of cost optimization is about sustainable growth, right? And being aligned with revenue goals and overall growth of the organization. So with that, we have 91% of the responses in here. Let's see what people said. So we see what people's company strategies were for cost optimization. The leading one was what I just talked about, the cost cutting, the short-term view, the 28.3%. We also saw 27% talking about streamlining operations and increasing efficiencies. And then let's see, next was advanced analytics and spend management tools, as well as reallocating resources to high priority projects. So, a good spread here. Let's see what the actual survey results told us, though. So, our survey results told us that over 50% of the finance leaders have really made significant progress in their cost optimization, really through two primary ways. The first one being technology rationalization. And in technology rationalization, an organization evaluates and seeks to optimize the technology stack, right? So they want to make sure that what they have is the most efficient, it's the most cost effective, and it's aligned with the business goals. Now, that does not mean if they go through this evaluation, this rationalization process, they're going to scrap everything immediately, but they're going to think about what their technology roadmap needs to be in the future. So oftentimes we see our clients do an assessment where the organization reviews all of the technology applications and services in use. And then from there, they go about identifying and removing redundant applications or outdated applications and technologies. They might also consolidate or combine similar technologies to streamline operations. And the last word, and the word we hear a lot in the market today, is modernization, right? So that is prioritizing which technology applications should be upgraded or replaced to improve performance and support future needs. The other way that finance leaders have made progress in cost optimization, and it's very similar, right? It's along that same technology theme, and that is the utilization of cloud-based systems. Oftentimes, and I think probably many of you today have probably been through the implementation or the transfer to a cloud-based systems. Oftentimes, that decision to move to a cloud-based system came about through that technology rationalization exercise. Our survey, if you look on the graph on the right here, our survey also told us that over 50% of the finance leaders also have used generative AI to move the needle in their cost optimization efforts. If we break this down by public versus private companies, survey respondents from public companies were definitely more likely than private companies to achieve meaningful cost optimization through some of the more advanced tools, AI being one of them, machine learning, RPA, and advanced automation. So the public companies really leading the way there in terms of these advanced technologies in cost optimization. There's several other ways to achieve cost optimization, and many of you have probably been through some iteration of these over the past few years. Maybe some of you have some of them going on now. So there's 6 things that we wanted to talk about for cost optimization. So the first one, business process reengineering. You can do this in a number of ways. It could be as simple as taking manual redundant tasks out of the process in small increments. It doesn't have to be the big bang enterprise transformation, right? As you're evaluating and analyzing, you may have an end-to-end enterprise-wide plan, but you don't have to do it all at once. It also might be looking at the cost model of performing some of these tasks. We do see many organizations, perhaps those that have grown pretty rapidly, that have had team members performing the same task for many years. And while they're very proficient at it and they've gotten as good at it as a human can be, right, through their years of accumulating knowledge, maybe the people have moved up in the organization, right, and in the organizational hierarchy. And they come at a higher cost, right? Their compensation is higher now, but they haven't given up that task. So oftentimes it involves just reallocating some of the tasks of the organization. The next item is zero-based forecasting or zero-based budgeting. Some companies have elected to move towards this strategy as a way of optimizing cost. In a zero-based approach, it's really a method where each period starts from a zero base, meaning you wipe out all of the prior assumptions, the prior history, and you build it from scratch, right? Rather than basing it on previous periods' data. And the reason why this works in some organizations is that it gives you a fresh start in building what your cost model should really look like without any preconceptions. Many people will argue that it increases accuracy. It creates more precise and realistic forecasts by avoiding the biases that might have been there by relying on, oh, we tried this before, it didn't work. We tried this, it didn't work, right? It's taking a fresh look at things. Oftentimes companies inadvertently come up with this approach just by putting some new leaders in place and taking a fresh look at things. And finally, with the zero-based approach, it allows for flexibility, right? It allows for adjustments based upon the latest market trends, economic conditions, and organizational changes. Another method is automation, right? So this follows the theme that we're talking about today with AI, but even automation without a heavy AI portion can help to achieve the most efficient operating model. Therefore, it's going to give you a better cost structure. So what I like to tell people is that similar to process improvement, advances in automation don't have to be end to end, right? You can pick the area maybe that's causing you the biggest pain or is the highest cost in your organization or that's going to be critical to being able to manage as your company scales. Because even introducing automation in small increments can have a meaningful impact to your cost model. The next item is procurement spend and working capital. So many companies have approached cost optimization by focusing on the procurement organization and the procurement process, specifically standardizing and centralizing the procurement process with an eye towards the cost model throughout the organization, right? While we hear a lot of our clients complain, oh, everything has to go through procurement, everything has to go through procurement, that does add an element of control and some overall rationalization of who you're spending with, who your key vendors are, where you can get some great negotiated terms with some vendors. And oftentimes there's room to move not only direct spend, but indirect spend into this centralized, standardized approach. And this might result in identifying some low-hanging fruit as you're working on your best cost optimization strategy. The fifth item is taking a fresh look at your operating model. And this is your operating model not only in a finance organization, but throughout your organization, regardless of the type of business that you're in. What we've seen a lot of companies do is be able to really align their service delivery model with their cost model and their revenue plans. In many cases, by taking a fresh look at the operating model, this also gives you the framework for many, if not all of the other 5 items that we've outlined here. Many people start with that operating model and then build off of things from there. And then finally, the last thing we wanted to talk about is what we're calling here technology cost containment. What I mentioned a moment ago is technology rationalization, right? It's all related. It's looking at that overall technology stack and looking at the technology roadmap of the organization, aligning it with the growth and the projection plans for the company to find a way to really achieve the best cost model for the company. So with that, also in our survey, we asked survey respondents about the technologies that they found to be the most valuable in achieving cost and efficiency, specifically related to the finance organization here. And as you can see here in the overall results, the first 4 were pretty close in ranking, and the first 5 are really all things that we've talked about today. The last one, the offshoring of technology, something that was very popular not that long ago, was not as popular this year, right? In years past, we've seen massive offshoring efforts that were leading the way towards cost efficiency. Now we are definitely seeing a swing because of the technology that is available to us, and a variety of options, that the first answer isn't always offshore or outsource it. So it is time for another polling question. We're going to pivot a little bit on this one, and we are going to talk about how your finance organization is currently being staffed. So you can select all that apply here. There's only 4 options, and that is full-time employees, staff augmentation, whether it be freelancers, contractors, or something similar, managed services providers, right, where you're managing some of it and you have somebody else temporarily, you've given them the keys to your organization, and then finally fully outsourced. And we'll give everybody a moment to complete this one. This is our last polling question. And we are almost there. We'll just give it a few more seconds to get us hopefully up to at least 75% of people responding here. It's amazing when I say that, the numbers jump up. Okay, we've got a good number of responses here. Let's see how you all voted. Okay, so 83.5% are staffing with full-time employees. We still have a good bunch, 31% using staff augmentation, followed by managed services providers at 11%, and then fully outsourced at 1.5%. So this is an interesting statistic that we look at every year, and we have seen some peaks and valleys and some shifting in how organizations are staffing the finance organization. I know the print on here is a little small, but these are the 6 functional areas that we looked at. And we looked at 3 years of data here because, as I said, we have seen a swing in the responses. From 2022 to 2023, we saw a notable swing in the move to more full-time employees. But then from 2023 to 2024, it backed off a little bit, right? And the trend went back the other way. And as we see with our clients, there's a few reasons for this trend. As we've heard today, there is a shift in the types of things that the finance organization is being asked to do, right? All the things that Andrea talked about. With those different things comes different skills. The deeper analytical skills required in FP&A and strategic finance may not exist in organizations today. So companies are looking outside, at least in the short term, as they're defining and maturing these processes before they create the in-house operating model. We hear a lot, we've had companies come to us and say, hey, can you come in, teach us how to do it, support us as we're learning how to be good at it and as we're perfecting it, and then hand it back over to us and we'll do it on our own. So that might be what's driving some of this. I think the other thing that's driving some of this is that companies have had to think about optimizing their costs, and they're doing so with a variable labor model. And particularly in the first 3 areas here, which are transaction heavy, full outsourcing is still rather low, but in the transaction processing areas, the heavy transaction processing areas, staff augmentation and managed services are becoming a more popular approach to do it, because then you can scale up and scale down as your volume dictates for that. So we have seen that as a way to also look at the cost model. So something interesting to think about and see how it relates to your organization. So with that, we've covered the key points that we intended to cover today. And I want to just do a minute or two to recap and invite Andrea and Chris to chime in here as well. But here's a few things to remember. Number one, if you haven't already done so, take a detailed look at the opportunities to integrate AI into your activities in the finance organization. This might include examining and evaluating the AI functionalities that you already have within your existing ERP systems or other finance solutions before you go to determine if you need to purchase some standalone tools. The other thing I would say is, as you think about cost optimization, consider the relationship between the capabilities and efficiencies of AI and other advanced tools. This might require an investment now, but again, we're talking about cost optimization, something that's scalable, not cost cutting, but it's something that would give you a scalable cost model for the future. And as we talked about before, this could be done hand in hand with a technology rationalization exercise. And then finally, the last thing that really impacts a few areas here is continue to work with your HR, your talent management teams to make sure that you're all in alignment with the new skills that are going to be in demand as the finance organization continues to shift to a deeper focus on the FP&A and AI activities. It's going to be very important to really rethink the plans that you have in place to attract, develop, and retain the individuals who are going to be able to do these activities. It's also going to be important to do regular assessments of the finance function's technology talent, and then be able to map this to the competencies that are required to achieve both the short-term and the long-term goals. So with that, we did have a few questions come in here, so I'm going to turn it back over to Chris, who will run us through those questions.
Andrea, thank you for your really great information on all the topics we plan on talking about today. I'll reemphasize your point number 2 on the key action items. Really, AI not only is a means for automating things like FP&A and saving money, but really for energizing the newer workforce generation to stay in accounting and be part of your finance organization, letting them be accountants and data scientists. It's really, that relates a lot to our findings, number 6 about the leadership in the organization, and number 12 about HR. So there's just a lot of ways that can affect how your finance function operates and how you keep your people motivated and trained. And your views, Andrea, on how to gauge the skills and the tech savviness of your team are spot on, right? That's really how you're going to make sure that your finance organization is able to emerge going forward and really work among the various workforce generations. Some people will know what to do with AI. Some people will know why you need to do it. And that working together can create a really good answer for your department. And with that, we do have some questions, and we'll move into that Q&A. The first one, and I'll address it briefly. The question was, what was the difference between the US and the rest of the world on our responses? And because it was about a 55-45 split, non-US to US, really not much, because it was a global and a large enough population that it would have taken a major trend for it to shift. I will say, though, that within the European Union, the European countries, ESG was a little bit higher than it was for the rest of the world, but that makes sense because the European Union has the Corporate Sustainability Reporting Directive, CSRD. They've got a near-term regulatory need to report ESG data, so that all made really good sense. For Andrea Vardara-Thomas, maybe you can tackle the question we got on really what are some of the AI applications we're starting to see people use in finance?
Yeah, I think Andrea Spinelli mentioned it, but within the current ERP tools that you're using, there are capabilities that are already built in. So exploring those first, and like an easy example is a 3-way match tool. That's a way to automate, to leverage AI within the tools that you're using. When you start to expand beyond, the process efficiencies, and I think that's where you'll mostly see those tools embedded into the ERP. I think it's on the business planning and analysis side that there's other tools and technologies. So it's modeling platforms. I know Microsoft has a platform, and really exploring those types of tools for ingesting a significant amount of data. Because if you're building financial models through machine learning, you're going to want a significant amount of data points. So it's really the tools that can ingest data sources from multiple sources, large volumes of data, and then building your financial models on those platforms.
Great, thank you. And I know I moderated a panel recently, and cash application was another one of those seemingly mundane areas where AI can make your life easier. When you think about high volumes and checks don't have the bill number on them, et cetera, within a lockbox environment or outside of it, that seemed to come up. Andrea Spinelli, one of the questions was around whether or not cyber issues have driven some of this decision to maybe onshore or reshore as people view their target operating model of their finance function. Has cyber been one of the reasons, or I would ask the question differently, one of the many reasons that people are seeing that be in flux, whether you're offshoring, onshoring, reshoring, et cetera?
Yes, absolutely. And I think we've all seen the news of all of the cyber issues that have happened over the last 12 to 18 months. And people immediately think, oh, that's the CISO's problem. Well, no, it ultimately becomes the CFO and the CAO's problem when they can't do anything in finance and accounting because their systems have been hacked. And in many cases, we see our clients, the CFOs, driving the organization to take a fresh look at what currently has been offshored. And people are less and less comfortable with that perceived lack of control, right? The further it is from you, not even just the geographic distance, but just the further the day-to-day operations are from you, people are not as comfortable. We've seen many organizations at a minimum go through the exercise of looking at every task that has been offshored and say, does this still make sense for us? So yes, cyber is definitely driving it.
Great, thank you. It makes sense when you put it all together, what's driving some of these answers and why cyber's been on the list for as long as anybody can remember, even with accounting issues not being on the list now for accountants.
Yeah.
We have one more question that we'll cover, and then there was one question that I'll hand to Liz when we wrap up. But the question was, how do you use AI in internal audit or AI in IA? And so the challenge there is for the internal audit functions, there are a lot of ways that you can look at it, right? You can be auditing AI as the object of the audit. How is the company using AI audit? Is it being used responsibly? Are you maintaining the security perimeter? And you can use the same AI tools that have the same kind of functionality that Andrea Verdaro Thomas talked about around automating process and gathering data and looking for anomalies that you use in finance. You can use that to actually do audits of any kind. So you can use AI to audit. AI can be the thing that you do audit, and especially as companies start to dabble in it, it's a new and emerging area that comes with risk in some of the other areas we talked about, cyber and data analytics and reliability of data and how it affects FP&A. So really, there are a lot of potential applications there. And so with that, I'm going to hand it over to Liz, who can also answer the last question, which was, will we get the slides from this presentation? So Liz, if you could please wrap us up, that would be great.
Yes, absolutely. We will be issuing the slides for this presentation, so everyone will get those and instructions for that. So a big thank you to everyone for joining us today. Thank you to Chris, Andrea for their guidance. And as a reminder, you can connect with our speakers by visiting the bios window on your screen. And we look forward to having you join us for a future webinar soon. Please enjoy the rest of your day.